Good afternoon, and welcome to Baltic Horizon Fund Investor Conference webinar. The webinar will be hosted by the fund manager of Baltic Horizon Fund, Tarmo Karotam, who will be presenting company's activities and financial results in the fourth quarter of 2018. Before we start the presentation, I would like to remind you that you're welcome to ask questions from the speaker by using the question box on the right-hand side of your screen. The questions will be answered after the presentation. Without further ado, Tarmo, I invite you to start the presentation.
Hello everyone, this is Tarmo Karotam joining from Vilnius, and together with Algis Vaitikunas, another board member of Northern Horizon Capital Estonia. So we're both here on the line and we'll give you an overview of last year's results and performance. Let us know if you have any questions. There is a question box on the side, and we hope to give you the answers to the questions then at the end of the presentation. Without further ado, then let's kick it off. And as usual, we are presenting the main events in a bullet point format, to start things off with. Again, I think it's now even more important to highlight one of the key events of last year being the bond program, which we started the beginning of the year. And the idea was to diversify capital structure, the sources for capital for our fund acquisitions and fund performance. We were able to get Standard & Poor's rate our bond as well as our fund with an MM3 rating, which corresponds to BB plus rating on a global scale, and quite satisfied to successfully and quite quickly actually completing the bond issue in April last year. So that has set the tone really for the remainder of the year. We executed the bank loan renegotiations as well during the second quarter. We were able to pay back some of the loans and lower the LTVs with the banks to levels as low as 40%, and use the remainder of the capital raise to together with equity acquire new assets. And in May we acquired a adjacent land plot next to Domus Pro shopping center complex here in Vilnius. It's one of the last remaining land plots, which is directly on the Arteria Lukmerges street. It is very much a very quickly developing, one of the most quickly developing areas in Vilnius. So if anybody gets a chance to visit the complex, in this quarter, I would welcome you to do it, because the neighborhood changing very quickly there. And also we signed the acquisition of an office building in Riga, LNK headquarters, and we have two long-term tenants, LNK and Exigen. The building is fully let, and we're quite satisfied to have made this acquisition in the office segment in Riga. So we now own 4 properties in Riga, 3 office buildings and 1 small supermarket. And last but not least, we signed another office building transaction here in Vilnius at a 7.1% yield, and with absolutely amazing tenants. I think it's not even an understatement here. So it's the top of the market basically. Vilnius Heating, a municipal company, Sweco listed Swedish company with their back office, AstraZeneca, Coca-Cola, and Rimi Lietuva with their office. We won the tender, and the reason being that the back office location is attractive both logistically, but also the quality of the building is absolutely fine, and very competitive also in terms of pricing. So most of these tenants operate in 2 floors, some of them on 1 floor, so they were able to move in, or still some of them are actually moving in over the coming weeks, but we expect to have full occupancy by next month. This building came as well with the 2-year guarantee on the NOI from the seller, YIT development company. Something to highlight is as well the whole year that we were able, even during the acquisition process, maintain a strong dividend yield, and this is because the portfolio has grown now to a sizable amount that a couple of acquisitions don't necessarily affect the generated cash flow from the portfolio as much as perhaps 2 years ago. And the GNCF, which is a generated net cash flow yield for 2018, increased to 8.4%, of which then we paid out a bit lower on a quarterly basis. But I think some of the following banks that do analysis on Baltic Horizon have it right that the efficiency of the fund has improved and is likely to improve further. Also, due to the improvements and positive signs in the unit price on the stock exchanges, we have currently put the buyback program on hold. We still have the mandate to continue with it in case we deem necessary, but we feel that it did have some effect on the average sort of return for the equity investor, and that was a target. But currently we have no immediate plans to continue with the program per se. Here's a good depiction of the events which happened in 2018, and once again on a below there to highlight the sustainably increasing dividend payouts from the operating cash flows, and at the same time, working with the capital sources and with the bond, where we did have the tap for the bond as well, another 10 million in December, and at the same time we are keeping equity investors very close, since we do believe that the market is offering us very interesting opportunities, and I'll get into that in a second. It is not a secret what is happening in the Baltic banking world nowadays, and it is one side is of course the Danske Bank AML KYC discussions and situation, but on the other side we also see that the Baltic banks that are operating there have consolidated and have become more picky when it comes to which assets to finance, and it affects the real estate market in a few different ways. One way is that the sellers of properties are not able to maybe move as quickly as they want to, because the discussions with the banks just take a lot longer than usual, and the expectations of the sellers are being sort of curved downwards, because if they do really want to sell their properties, they need to be quite realistic about their price expectations. On the development hand, with our portfolio, we do feel quite comfortable actually with our occupancy levels, because the slowdown in let's say bank financing processes has also is also curtailing the advancement of developers, competition of new buildings, and that shows in our office building occupancy rates, which were quite high already in the past. But for us as a leading market player, we are definitely looking for good market opportunities, good strategic assets that usually come to market in these times, and we're really preparing for it in many ways. Shown also in the previous slide that we have a bond program ongoing, and also we are discussing with equity investors quite on a regular basis, and also in this webinar, so about developments and events in the market. And we are also very open to off-market opportunities to acquire assets and grow in addition in exchange of fund units. So this is something that has been many times also been proposed by sellers of properties, that we would be actually interested in getting fund units of your fund as payment, since then we have the flexibility of either earning the dividend from it over long term, or reinvesting then the money when they actually see fit. And last but not least, we are strengthening our team at NHC. So a designated portfolio manager, Katre Plan, has joined the team to take care of the portfolio in a very active way, and she has a very good experience also in shopping centers and in retail, which is and has been a priority for us to strengthen that side for some time now. And as well, we have a new analyst, a real estate analyst, Kati, both in Tallinn office. So we are ready to face the market in a very active way. As usual, a standard slide that we also present is the update on the portfolio, and it has been over the quarters been growing and growing. I think it's still readable, but no major, let's say, changes here. I think we're quite happy with our diversified portfolio of centrally located assets, and as well, back office buildings, which house such these international tenants as G4S and now Rimi and Sweco, and some municipal tenants such as Vilnius Heating, Vilnius Water Supply, and as well a Latvian governmental tenant, Latvian State Forestry. So some investors have actually asked me that, how many of your tenants now are Baltic financing institutions, and the number here is actually around 5-6%, which are some of the back offices of international financing institutions such as Nordic banks. So we're very satisfied with our diversified, let's say, tenant portfolio with long-term tenants that have signed up for quite a few years, and I think this is the cornerstone really of our cash flow portfolio, which has now grown to more than 260 million euros. On the right side, on the most right column, you can see the total and average numbers. So we have about 122,000 net leasable square meters. Our vacancies are on a portfolio level low, and with the largest being, in some of our retail assets, and we're working hard also on Pirita shopping center to bring in more destination satellite tenants there. But the churn of tenants in retail area, retail centers, it's quite normal nowadays, and also in the past, that the consumer habits and the types of tenants are changing regularly. So weighted average on expired lease term is more than 5 years across the portfolio, and this is the fixed period. Another slide just depicting the diversification that we have between retail and office. We have strengthened consciously the office allocation in our portfolio because of the expected long-term lease agreements that are in place, and the strong demand in the office segment across the countries. In Latvia, the office segment remains the most undersupplied. In Tallinn, I think the supply is somewhat, maybe a little bit exceeding the demand, but still at a healthy level. Whereas in Vilnius, in Lithuania, the current demand versus supply is relatively balanced. There are many office buildings, continuously being planned in Riga and Vilnius especially, but here again, the banking situation might, let's say, the conservativeness in the banking situation may slow the processes down, and only the strong projects with the strongest pre-leases are the ones that actually do see the start of construction. And here is another pie chart of the rental concentration, and then the top tenant now is Rimi. But I think the over the years, and over the past quarters, you've seen that the top tenants form less and less of the portfolio, which shows the diversification of our leases. An update on the finances. We have. It's very important to note just that we have almost no debt amortization due to the bond program that we executed, and the pay down of the loans that we renegotiated and fixed last year. So the weighted debt maturity, including the bond, as of end of last year, is still 4 years fixed remaining. The cost of debt has slightly increased, and this is currently at all in, at 2.4%, which we still consider attractive, very attractive, assuming that we have no debt amortization. And the LTV as of last year, end of last year, was slightly higher than in the third quarter, but the LTV is, in our case, we want to keep it as low as possible, and the long-term goal is to leverage the portfolio to 50%. So we are working on getting that LTV down once again in the next quarters. And this is a very good slide also, which visualizes where some of our property loans are and when are the maturities and how we have tried to manage that over the coming quarters. So the next loan to be sort of refinanced is in end of 2021. So we still have a good 2.5 years before that happens, and of course the financing market has definitely for us meant more focus on the bond market and bond investors and how we go forward with the bond as a source of financing, as an attractive source of financing. So we definitely are moving towards that direction and having discussions internally and externally how to be very competitive and very, I would say, very flexible in these times. So when the banking sector is facing all kinds of challenges. This is more of a European consideration for our portfolios in the office segment, and I guess this is just to highlight where we are in regards to yields in comparison and as well as vacancy and rent level comparisons. I would say that the average rental levels of our office buildings in the Baltics, especially in the back office segment, are still very competitive for these international companies that are looking to establish their back offices here, and that trend hasn't changed. It has rather strengthened, regardless of the increase in our salaries. Of the Baltic population, working population. More and more value-added jobs are being created here. So if 10 years ago the call centers moved in, then the call centers are now being replaced by financing centers and IT centers. So that can sustain a bit higher cost of labor, but still being very competitive to locations such as Frankfurt, London and Paris, even in some comparisons. It's also very interesting to note that in the Baltic capital cities, the modern office stock, including built to suit for these financial institutions, has in all Tallinn, Riga, Vilnius achieved the same amount, which is around 650,000 square meters of modern office space. So we're far away from the modern office stock of, for example, Stockholm and Helsinki. So on one hand, you have seen some major development of offices here in the Baltics, but on the other hand, you would estimate that the market growth potential is still very much there based on the per capita figures. And you can see that also from the demand. That demand is strong continuously, and all these tenants are looking to expand their operations here. So this is very interesting to see, and if you talk about 650,000 square meters in Riga and 650,000 in Tallinn, then you would also understand the huge demand which is not currently catered for in Riga, because Riga is almost twice the size of the city of Tallinn. So interesting, I think, potential in the office segment, in our opinion. Now, retail is a bit of a different story, and retail in many cases in real estate world is considered as a swear word, and nobody understands retail. Everybody is so afraid of it. Nobody can predict it. what exactly are affecting the changes in retail. Is it consumer behavior? Is it travel habits? Is it e-commerce, or is it just lack of interest in spending time in big box shopping centers? So it's a big question mark for many. And in our case, where we believe the long-term, let's say, value preservation or growth in retail assets is in the hearts of the cities. And hence our transactions over the past years in the central areas of the cities, such as in Vilnius we have Europa Shopping Center, and in Tallinn we have Postimaja. They are more like lifestyle centers rather than destination shopping centers. And we also believe that tourists are the ones that are positively affecting these centers and are somewhat also minimizing the effect of e-commerce in such central locations, because when you're a tourist, you go to a destination, you don't go there to do online shopping. You go there to experience the local food and beverage scene, and some local brands, and even some exercising for that matter. And you might as well then pick up maybe one or two things at the local H&M, which you normally don't do. So we do believe in central locations, maintaining their attractiveness in the retail segment, whereas large destination shopping centers are seeing and have seen and will be seeing a large amounts of investments needed to turn them around, to make them again, attractive for customers, turning them into mini cities, as they call nowadays as well. So the capex requirements are quite enormous in large destination shopping centers in the outskirts. So we rather keep the focus on the central business districts. But this is a fact that disposable income growth of the Baltic people has increased considerably over the past 10 years, and in many cases what you do see in shopping centers today in the Baltics is that the footfall is stable or slightly declining, but the average check is making up the difference very solidly, and that's more and more the case. In terms of competition, T1 was opened in Tallinn and hasn't had any major effects on the other shopping centers, per se. But I think all shopping centers, especially the large destination ones, are being affected by other market trends, and not just one shopping center opening their doors. In Riga this year, Akropol will be opened, and that's already being planned as a large mini city. So I think they are quite well positioned to attack the market, but remains to be seen how they affect the market, probably more than in T1 in Tallinn. But as well, our idea, our strategy is stay away from investing into such large shopping centers due to the reasons described before. I think these have been the key messages for us and for the investors in the past quarter. Now, a few words about the financial performance in 1 year, and due to the additional acquisitions, but also some rental growth in some of our properties, we have achieved a net rental income of close to 4 million. So annualized rental income of about 16 million plus. We didn't have that much in terms of valuation gains. We're still very much working on the expansion projects, and that's where we believe our large valuation gains over long term will come from. But in Q4, on over the portfolio that was around 1.5 million euros. And otherwise quite a stable performance quarter by quarter. And CapEx amount was roughly 700,000 euros for the whole portfolio in 2018. So that shows the good quality of our assets, and the underlying idea for us is to buy new assets just to minimize the CapEx risks, and as well optimize the costs for the tenants. For example, Duetto 2 office building, brand new, has a BREEAM very good certificate. So and will definitely be a good host for the tenants that have been there. In this slide, just cash and cash equivalents, about up to 12 million at the end of the year, was actually the bond that we drew in order to be able to work with that capital now in the first quarter. And we're definitely working on some very interesting acquisitions, but also continuing very much our expansion plans. And I think this year will be a major year for us to move forward with some of the office expansion opportunities that we have in our portfolio. So patience still, please. There's work to be done and things take its time, but I think we're quite excited that this is the way we can also add value to the portfolio and eventually to investor return. So the interest-bearing loans and borrowings, that includes also the bond. We are around 110 million in terms of NAV, and overall the price on the stock exchange has been, between 3 and 5% discount on average, whereas even in the past few weeks we've seen in Stockholm even days when the results are trading, or the fund is trading at a slight premium. And actually that's what we do believe, long term, because in today's market environment, to achieve the cash on cash returns of around 8% is quite attractive. And some of the interesting feedback we've received also from our larger investors is that the most stable, we've been the most stable, investment for them over the past 2 years, especially in the Q4 of last year, when the markets actually lost, at some points 10 to 30% in some equities. So with our 2%, 1.8, 1.9, 2% dividend on a quarterly basis paid out to investors, that's been very much appreciated. So EPRA NAV is definitely something to monitor as well. That this is the when you do exclude the deferred tax liabilities from the calculations, which are basically the liabilities that are being postponed, and just to more zoom into our loan portfolio, which is, I think, today is more important than ever before, is that not only we have now diversified the bank loans with the bond, we have 90% of our loans fixed with the rate. So if we do nothing for the next 4 years, that's what we'll be paying, 2.4%, without any amortization. So and this is definitely our goal, to keep the cost of lending down, and as well the amortization of the loans, in order to be able to use the cash for dividends and for all other opportunities or options if the opportunities arise. Maybe a comment still to make here is that bank financing is expected to get more expensive, not only in the Baltics but across Europe, and this is why our goal is to maintain our quality investment strategy in order to be able to issue fund level loans, potentially even replacing the bank loans at some points. And having a diversified portfolio with leading properties and tenants would hopefully allow us to get lower and lower bond coupons as well. So we started off with our first introduction to the market last year was at 4.25%, and we hope that over long term this is where we will be able to sustain our low cost of financing with the help of capital markets. And last but not least, we have been able to be very active on a stock exchange, and we have listed the fund in Tallinn, Stockholm, and listed the bond in Tallinn. So I think if you can see from the trading that there are loads of investors that do buy and sell. So I think for Baltic states, we are considered as a liquid equity for sure. At some months and some quarters, we've been in the top 5 in terms of liquidity. Right after Tallinn Port and Tallink and some of the larger Baltic companies. And I'll see if I can take some questions. I see there are some questions. Concerning the buyback program on hold, can you elaborate at what discount from NAV management would continue purchasing units in the market? That's a very good question. I think when we initiated the process, then the discount at points were at 8%, and that's where we felt that it's for us it's a bit too much. And now the discount is between 3 and 5. We do feel comfortable with that level, and we also do see investors actually buying units from retail investors. So it's, I would say, this is where we feel comfortable as well. We'd rather keep our liquidity in the books at the moment and see if we can take advantage of some new opportunities in the market, cash flow acquisitions, and as well the investments into expansions are starting to need more capital as well. So I think -5 could be the sort of the soft threshold that we consider acceptable. -5%. Next question, funds target equity to debt ratio is 1. If I remember correctly, yes. Having in mind tightening situation in debt costs, would management consider lower debt levels to maintain growing interest costs in the future? I think this is a very good question. The answer here is something that we're discussing internally too, because having a strong capital structure in place doesn't necessarily need to mean that we are increasing the leverage of the portfolio. And it's a bit of a trade-off. I think you know, our long-term LTV goal is still 50%, but at times you know, it could be slightly higher. I think we, in today's market situation, we would rather have maybe 1 or 2 properties in our portfolio without a bank loan, meaning that, you know, we do invest the equity, but we could maintain our LTVs at a competitive, at a very conservative level. So this is definitely something that we're calculating and preparing for. So I think the answer would be here that we are let's say approaching this topic relatively positively. I think this is the time of the market when you should definitely not over leverage, but rather be ready for new opportunities. So hopefully this answers the question. It's not the first time management mentions the expansions. Could you briefly elaborate on upcoming projects to increase current assets value and some dates? Well, I've indicated in the previous presentations that this is the expansion rates that we do have are dependent on various things, and they're definitely dependent on pre-leases, but they're definitely also depending on availability of financing and good construction costs. So maybe if I would answer it this way, I think the progress is definitely expected, you know, this year with potentially 1 project going into construction. I think next year, if market supports, we have timed that we expect that the timing of several constructions, start of constructions, will happen next year actually. So it's a bit too difficult at this point to tell you all the dates. But since this is a very specific question, I will try to answer that, if not sooner than in the next webinar, and really spend more time on at least the preliminary timelines. We do have them in place, but unfortunately, you know, sometimes they're changing, and sometimes things take more time. And I could spend an hour just talking about our expansion projects. So maybe let's aim for a good coverage of those projects in the next webinar, if not sooner. Valuation below. Valuations of Q4 are below of the last year. Last quarter. And do you think Baltic real estate market is slowing down? I do think so, and I've openly said it, that you know, the train is definitely slowing down, and you have to look at it from various perspectives. I think if you look at the yields are definitely have bottomed out. Some prime yields, prime transactions have been made over the past quarters at levels below 6%, and those have been office buildings in Vilnius at 5.7, 5.8%. Of course, they are considered the prime properties in the Baltics, but I think overall, if you go move a little bit to the secondary levels of the properties, then it's definitely 7+%, and if you move outside of the city, capital cities, then for sure it's more than 8%. And so I would say in some cases, in some segments, the yields are actually turning upwards. And this is affected, of course, by market sentiment, affected by cost of financing. So in this sense, it is slowing down. When now you talk about tenants and how they are doing, then I think if we look at our portfolio, then the tenants are making more and more money than ever before, and one needs to really analyze their own tenant portfolio, especially in the retail side. Which tenants are sustainable, and which tenants still have good buffers in order to go through various cycles. So it's definitely interesting times. But again, I do believe that especially in the office segment, the supply of buildings is not considered as an oversupply. I think it's currently matching the demand quite strongly. I think the demand continues to be there. It is estimated that in Vilnius the take up is between 70 and 80,000 square meters per year, just from the growing tenants, so it is considered quite sustainable, at least in the office segment side. But one definitely needs to be very analytical about what type of properties they have, and maybe just to conclude this comment, if you talk about slowing down, then it could be definitely in a transaction market that the sellers that wanted to sell may consider that, okay, let's keep the property for another couple of years and then see where the situation has taken us. But when you're a developer or somebody that wants to sell and needs to sell in order to pay down, some obligations or any similar, then this is where we hope to actually make some good deals in the coming quarters. Yeah, I think I answered the other question about yields bottoming out. Next question, you're reporting both to EPRA earnings and GNCF number. Are they not essentially measuring the same things, cash flow available for dividends? Why do you report both? I think the answer there is that we're the member of EPRA, and this is something that listed the real estate funds REITs do on a regular basis. It's a professional, let's say, indicator. And generated net cash flow is a more precise, actually a term that we have fine-tuned ourselves in order to really show the cash flow generation quarter by quarter from operations. So I think GNCF and the payout ratio is definitely very important lines to follow across the quarters. Next question, are you looking at any industrial logistic type assets? Answer is no. Next question, what do you think better reflects real value of the fund, IFRS or EPRA NAV? Very good question as well. I think IFRS is what they call a sort of a common understanding of how to do accounting, and EPRA NAV is a very specific, I would say, term in the real estate world, which specifies the IFRS NAV. And the key difference there is actually the deferred tax liability. And the deferred tax liability in normal circumstances would only realize in case we would liquidate the fund, sell the assets, and then pay all the outstanding taxes. Now, we are having a buy and hold strategy, so we're not planning to, sell or liquidate any of our holdings anytime soon. We are, of course, maybe considering maybe offloading and exiting from one or two of our smaller assets, but that's a separate story. And if we do sell the company instead of the asset, then there is always this discussion about deferred tax liability. Who covers it, either the buyer or the seller? So it's up to, I think it's up to anybody to decide on their own. I think IFRS shows a very good snapshot of the NAV, whereas EPRA NAV definitely shows the long-term potential of the NAV. So I would answer this question in this way. Could you please talk about Pirita? Yes, I can talk about that too. Pirita was an asset bought at the end of 2016, and it was a brand new reconstruction of an older building. So it was working as a supermarket back then, and that it became a let's say it became a bigger supermarket after the reconstruction, with the gym introduced to the building, the dentistry, some of the satellite tenants, some restaurants. And I think it was a transaction of relatively small transaction, and it continues to be one of the smallest properties in our fund. But I think the risk what realized there after the opening were the satellite tenants, which are in front of the RIMI cash registers, and it's about 400-500 square meters that I'm talking about. For this, the evaluators have assumed now higher vacancy assumptions, and as well a bit lower rental rates. So our strategy, which is a big part of our discussions lately as well with Katre, our portfolio manager, and how to bring this property around. It is to attract tenants there that are destination tenants, such as a pet store, which we have signed now. Kika, one of the largest pet store operators, is opening up their store in May. Also a wine store, which is a destination tenant, that generates traffic on its own. And we're hoping also well-known pastry shops, maybe a post office would be part of the tenant mix. So it's a long and hard process to assemble the right tenant mix, and that's maybe the reason why the valuation has also decreased now in the end of last year, slightly compared to the previous year. But overall, I think in many of our office buildings, our rental levels have been increasing, our NOI levels have been increasing, and this is what I and we truly believe is the success for the future. It is to have a diversified portfolio across cities and across tenants, and with the end of lease agreement terms managed, and also with a fixed cost of financing. So diversification is a key element in our investment strategy. So okay, there's been a lot of good questions. Thank you very much. I think we've also used up most of the hour. Hopefully many of the questions were answered, and I take back from this webinar, hopefully it was very informative, but next time try to spend more time on the expansion possibilities and the timelines of those, and the potential value creation of those, and as much as possible.
Yes, it seems that all the questions have been answered. And if you don't have any more questions, then we will be ending webinar here. I would like to remind to all the listeners that the summary of the webinar, together with the presentation and link to the recording, will be made available in today's investor event announcement from Baltic Horizon Fund. You can also listen to today's recording directly from the Nasdaq Baltic YouTube channel on webinar playlist. Thank you, Tarmo, for your time, and thank you, participants, for joining the webinar.
Thanks for joining. Thanks. Bye.